Canada has a complex taxation system when it comes to investment income. As a Canadian investor, it's important to have a clear understanding of the different types of investment income and how they are taxed in order to make informed investment decisions and optimize your tax situation. I will guide you through the basics of investment income taxation in Canada and help you navigate these often confusing waters. In general, investment income can be categorized into three main types: interest income, dividend income, and capital gains. Each of these types of income has its own rules and rates regarding taxation. Let's explore them in more detail. Interest income refers to the earnings received from investments such as bonds, guaranteed investment certificates, GICs, and savings accounts. This type of income is considered passive and is fully taxable at your marginal tax rate, which varies depending on your total income and your province of residence. The higher the marginal tax rate you fall under, the more taxes you will have to pay on your interest income. Dividend income is generated from investments in shares of corporations, either publicly traded or privately held. In Canada, dividends are either considered eligible or non-eligible for the dividend tax credit. Eligible dividends are generally paid by large Canadian corporations, and they benefit from a gross-up and tax credit system that reduces the overall tax payable on this type of income. Non-eligible dividends are typically paid by smaller corporations and are subject to a lower gross-up and tax credit. Both types of dividends are still taxed more favorably than interest income, which can make dividend-paying stocks an attractive option for tax-conscious investors. Capital gains arise when you sell a capital asset, such as stocks or real estate, for a profit. In Canada, only 50% of the capital gain is subject to tax, which makes capital gains the most tax-efficient type of investment income. Capital losses can be used to offset capital gains, further reducing the tax impact. With a solid understanding of the different types of investment income and their taxation, you can employ various strategies to minimize your tax exposure and optimize your after-tax returns. Here are a few common strategies that Canadian investors can consider. Canada offers several types of tax-sheltered investment accounts, such as registered retirement savings plans, RRSPs, tax-free savings accounts, TFSAs, and registered education savings plans, RESPs. By investing within these accounts, you can defer or completely eliminate taxes on certain types of investment income, leading to significant tax savings over time. It's important to choose the appropriate account based on your individual needs and goals, as well as the type of investment income you expect to generate. Understanding the tax characteristics of your investments can help you determine the most tax-efficient location for each asset. For example, since interest income is fully taxable, it makes sense to hold interest-earning investments in tax-sheltered accounts or within a corporate structure, if available. Dividend-paying stocks or exchange-traded funds, ETFs, as well as investments with a high potential for capital gains, should be held in non-registered accounts where the more favorable tax treatment can be utilized. As mentioned earlier, capital losses can be used to offset capital gains, reducing your overall tax liability. Actively monitoring your investment portfolio and selling losers to offset gains in the same tax year can help minimize your capital gains tax exposure. It's worth noting, however, that tax loss harvesting should not be the sole driver of your investment decisions and should be undertaken with a focus on long-term investment goals.